Hi there, and welcome to MPC Markets Quick Explainer on fixed coupon notes and how they work. During this explainer, we're going to use an investment that we did last August 2024 based on real estate investment trust that yielded 10.1% per annum. Disclaimer, this is for wholesale, professional, or sophisticated investors only. You must be S708 qualified to take on this investment. Further, the content presented in this webinar is intended for informational purposes only and provides general advice. It does not take into account your personal objectives, financial situation, or specific needs. Please note that past performance is not a reliable indicator of future results. Please consult a financial professional before investing in any of these products. Okay, so using the listed real estate investment trust, or the REIT, so we're trying to achieve a fixed coupon note. So essentially, where structured investments sit in terms of the investment scale is they can help bridge the gap between stocks and bonds, essentially. So you've got sort of yield enhancement, capital protection, with very limited upside participation in these. So the objective is to receive the yield, not necessarily participate in any of the risk to the upside, and a very limited amount of risk to the downside. So in this particular example, you receive 10.1 per annum, pay quarterly. Your capital is secured against the reference assets, which are the listed real estate investment trusts. Now, these are just ASX listed vehicles that actually own property and are valued on a 6-monthly basis. Where the downside is if the reference asset is down more than 20% at the end of the 3-year term, you simply just receive shares in the REIT, as well as your coupon overall. So with real estate, we obviously set a very close barrier or downside barrier of 20%, and that it sits in that nice area for income, which is sort of yield enhancement, capital protection, on that lower end of the risk scale. So the real estate investment trusts that we use were very well-known names in Australia: Stockland, GPT Group, Charter Hall, and Centuria. As you can see here, these at the time we put this investment together, these were already priced because interest rates were a little bit higher at a 20% discount to their last valuation. So you're already getting in at roughly a 20% discount to net tangible assets at last valuation. And as you can see, a lot of these really high value and high quality real estate investment trusts had very high quality tenants like the Coles Group, Bunnings Warehouse, Telstra, Australia Post, the Arnott's Group, Woolworths, etc. So we specifically chose what was 4 of the most boring and least likely to go backwards REITs, because what we were looking for was stability, not necessarily upside growth. For instance, Goodman Group is our high conviction pick in the REIT space here, but with $14 billion worth of development in progress through 82 projects, we essentially thought that was far too much risk, because obviously developments can go pear-shaped. So we chose these 4 very stable REITs as the reference assets, so we couldn't get into too much trouble. I'm going to give you an example now. So this is our AI-generated retired couple. They've got an investment property valued at $1 million. They're now in pension phase and want higher income. They don't really want to deal with tenants, agents, maintenance, etc. Property's obviously unencumbered, and if you went off the past 10 years average in Australia, the property yields about 3.35% per annum, about $33,500 in income, and then increases in value by about 5.55% per annum, which is obviously $55,500 in capital gain. So overall, $89,500 you would expect, excluding maintenance. I have included agents' fees in there, which are roughly about the 7% mark across Australia. Now, what we want to offer here is something that is still backed by property, but what if there was a low cost, low hassle way to earn more? So we pulled together those 4 reference assets that we spoke to you about before. We got a 3-year term at 10.1% per annum. The coupons were paid quarterly, so you were getting roughly about 2.5 and a bit percent per annum paid into your bank account. That just about doubles their income to 6.7% per annum. That's $67,000, which most retirees are very much looking for overall. While their total return obviously not getting any capital gain out of it, because it's 10.1%, the total return is still 1.2% per annum, or $12,000 more when you take into account the capital gains, all while completely simplifying their lives and getting them a far more suitable income base for their retirement. They're not dealing with the hassle of agents. They're not dealing with the hassle of tenants, bond hearings, etc. But essentially, if property were to go backwards by 20% or more, most people would agree that they would probably be happy to buy back in an Australian property 20% lower. So that's what you're effectively doing. If at the end of the 3 years, the downside barrier is breached by one of the REITs in the package, you essentially just receive the shares, and you've received your 10.1% per annum coupons over the course of the 3 years. You can early exit after 3 years, after 18 months of the 3-year period, but overall, it's a very stable and income-based investment for people that very much suit those in pension phase. Now, it's not just property you can do this on. You can also do this on shares. So one that we did recently in January this year in 2025 was a fixed coupon note, which involved brands you may have seen: Ampol, Treasury Wines, that owns Penfolds, and Fortescue, which is one of the ASX staples, is an iron ore miner. Now, in this one, we got a 2-year period, but obviously with shares being a little bit more volatile, we set the barrier at down 40% with the reference assets, giving us a lot more room for the ups and downs of what the share market does, which is usually quite a bit higher than the property market. But what we got there was an 11.2% per annum coupon, and still paid quarterly over the course of the 2 years. You can early exit this one after about a year as well. And we do have one of these fixed coupon notes coming up. They're a very popular way to lift the overall income yield from people who are in term deposits, where essentially they may add a portion of their term deposit into a fixed coupon to lift their average yield. These are incredibly popular with our pension phase clients, and we have one released just about every 4 to 6 weeks due to high demand. If you'd like to know any more about these, this is how you can contact us. You can contact myself on 0402 303 044, Kai Chen on 0422 959 562, Jonathan Takadena on 0416 167 456, or you can email us at invest@mpcmarkets.com.au. Thank you very much for listening. Hope to hear from you soon.